If you're still trading support and resistance the way everyone else does, you're being hunted. Every stop loss you place, every breakout you chase, smart money is one step ahead. In this video, I'll show you how liquidity really works, the two zones institutions target, and how to trade with them, not against them. We'll break down real chart examples, apply powerful filters, and reveal the truth behind supply, demand, and fair value gaps. This is how smart money trades. And after this video, you will too. Before we dive in, hit the like button, subscribe to the channel, and tap the notification bell so you never miss a smart money lesson. Let's get started. So, what is liquidity? Liquidity refers to clusters of stop losses, pending orders, and breakout entries around key price levels. These orders create the volume smart money needs to enter large positions without causing major price moves. But smart money doesn't enter randomly. They need traders on the wrong side. That's why they target areas loaded with stop losses and breakout orders, known as key liquidity zones. Let's start with the most common, support and resistance. Most traders expect price to bounce from these levels. Smart money sees liquidity, not entries. Above resistance, we find buy-side liquidity, buy stops from breakout traders, and stop losses from short sellers. Below support, we find sell-side liquidity, sell stops from long traders, and breakout entries from sellers. This type of liquidity is known as stop-loss liquidity. It's the fuel smart money uses to enter or exit large positions. They drive price into these zones to trigger those stops and then reverse the market. So, what are support and resistance levels? They're zones where price has shown clear reactions before, either rejection or reversal. They act as potential decision points, not guarantees. We draw them to highlight where liquidity builds and where traps and reversals often occur. But not every level is valid. Here are 6 filters to identify high probability support and resistance zones, the kind smart money hunts. Clear swing highs and lows. Look for recent extreme points, the most obvious highs and lows before a reversal. These zones attract orders and often act as liquidity magnets. Multiple rejections. The more times price rejects a level, the more traders notice it and the more liquidity gathers just beyond it. Visually obvious levels. Good zones should stand out instantly. If you need to force it, skip it. Obvious levels attract the most attention and the most orders. Strong reactions or sharp moves. If price launched aggressively from a level, institutions were likely involved. These zones tend to get revisited later, perfect for liquidity sweeps. Role reversal. Support becomes resistance, or vice versa. When a level flips roles, it leaves trapped traders behind, adding more stops and more opportunity. Recently respected levels. Focus on zones that were tested or formed recently. Fresh levels reflect current market sentiment and are more likely to attract liquidity. You don't need all 6, but the more a level checks off, the more powerful it becomes. Alright, take a look at this US dollar Swiss franc 1-hour chart. Notice how the price comes down, touches this level and reverses. Then it pulls back again, hits the same level and reverses once more. And again a third time, price reacts and bounces upward. This level has now been tested multiple times, and that's the first sign of a high probability liquidity zone. Why? Because multiple rejections mean multiple traders placing stop loss orders just below this level, and even limit buy orders stacking up around it. In other words, there's sell-side liquidity building beneath this support. Now let's add in the second trait. This level also lines up with the extreme swing low. It's the lowest point on the chart in recent time. That makes it even more attractive for retail buyers expecting another bounce. What does that mean for us? More stop losses below the low, more limit buys in the zone. In short, a perfect liquidity trap. Third trait? It's obvious. Anyone opening this chart, beginner or advanced, will spot this support level immediately. And when a level is that obvious, it becomes a hotspot for orders. That's exactly what smart money looks for. Crowded areas where they can trigger a liquidity sweep. Now, watch what happens next. Price pulls back, then breaks below the support, triggers all those stop losses, grabs the liquidity, and then reverses with strength to the upside. This is a classic liquidity sweep. Smart money pushes price just below the level to fill large orders, traps breakout sellers, and then drives price in the opposite direction. So when you spot a level that meets these traits, obvious, multiple rejections, and a swing low or high, don't rush to enter. Instead, wait for the sweep. That means a break below the level, followed by a strong close back above. That's your signal. Now let's look at another example, this time on Bitcoin versus the US dollar on the hourly chart. Notice how price moves up and hits a clear high before reversing. That high marks an extreme swing point, and it's our first clue that this is a high probability liquidity zone. When price forms a clear swing high like this, it naturally attracts attention. Traders start placing limit sell orders at the level, and those already in short positions place stop losses above it. This creates what we call a buy-side liquidity zone, an area full of orders waiting to be triggered. Now look closer. This level is also obvious. Anyone opening this chart can see it right away. And when a level is obvious, it becomes crowded. The more visible it is, the more orders it attracts, and that means more liquidity for smart money to target. Another key trait? This level was recently respected. Price reacted here just a short time ago, which gives traders even more confidence that it'll act as resistance again. So more sellers enter, and more stop losses get placed just above. Now watch what happens. Price pushes up, breaks just above the resistance, sweeps the buy-side liquidity, and then drops sharply. That's a textbook liquidity trap. Smart money triggers the stop losses and breakout buys, fills their sell orders, and reverses the market. As a smart money trader, your goal isn't to predict the breakout, it's to wait for the trap. Once you see price sweep above the level and then close back below it, that's your entry signal. The first type of liquidity we covered is stop loss liquidity, found above resistance and below support, where retail traders place their stops. Now let's move to the second type, imbalance liquidity. What is imbalance liquidity? It forms when price moves aggressively in one direction, creating a clear imbalance between buyers and sellers. These fast moves often leave behind unfilled institutional orders, turning those areas into liquidity zones. When price returns, smart money uses these zones to complete unfinished business, filling leftover orders, reloading positions, or trapping retail traders. These areas are known as supply and demand zones. A demand zone forms after a sharp move up, leaving unfilled buy orders below. A supply zone forms after a sharp move down, leaving unfilled sell orders above. Smart money often brings price back into these zones before continuing the move, either to trap early entries or collect more liquidity. But not all supply and demand zones are created equal. Some are strong and reliable, others are weak and noisy. The difference comes down to 3 key filters. Master these and you'll stop wasting time on low-quality setups and focus only on zones with true imbalance. The first sign of a strong supply or demand zone is the size and consistency